Head of Investment Strategy and Chief Economist at AMP Capital, joins in for a quick take on the global markets. Shane, hi. Thanks very much for joining in this afternoon. Why do you think the Chinese markets are down again today? Is it, and that too despite the fact that the Yuan might be added into the IMF reserve currency?
Well, I guess the introduction of the Yuan into the SDR reserve currency by the IMF, that's I think been factored in over the last few weeks. So when it comes, it won't be a surprise. I think what's really going on here is the follow-on from the announcements on Friday that several Chinese brokerages are under investigation for rule violations. And I think we're still seeing outworking of that. The Chinese market is very much a momentum-driven market. And when we saw those falls on Friday, that's flushed out some renewed selling. And so it's a bit too early to say that we've seen the last of that yet.
Shane, hi, good morning. As we count down to the Fed rate hike, and it looks like this time it will be a rate hike, do you think it's time to take a counter bet and bet on emerging markets? They normally bottom out within a month or two of Fed rate hike.
Well, that's interesting. The emerging world is very oversold, particularly compared to developed country stocks. And at the same time, investors around the world have well and truly deserted emerging market shares. And so the crowd has sort of gone away, if you like. So there is a good chance, I think, that once the Fed move is out of the way, and it will hardly be a surprise to anyone because we've been talking about this all year. It's been delayed twice. There's now, according to the US money market, there's a 70% chance of a hike in December. So it should be largely factored in. So I think once it's out of the way, there is a good chance that we could see a bit of a bounce in emerging market shares. But I'd still call that at this stage more of a bounce, from a very oversold position, because I think the emerging world still has a lot of challenges. Not so much India or China, but particularly South America. So I don't think we would be going back to the sort of strong conditions we saw last decade. Rather, if we do see a bit of a bounce following the Fed, it would be, a several-month affair rather than a new bull market.
Shane, can you leave us with your thoughts on where you think the dollar index could go beyond the 100 mark that it's already at?
Well, the interesting thing is that at the moment it's testing the highs we saw earlier this year. So I'm thinking there of the DXY index for the US dollar. So yeah, we've certainly seen renewed strength against the euro, but by the same token, it hasn't violated previous levels against the yen. My feeling is, again, it's a bit like emerging market shares, that history has often been that the US dollar rallies into Fed interest rate hikes, and once they're out of the way, it's a bit ambiguous as to which way the dollar will go. But my feeling is that the Fed's going to, when they do tighten, they'll stress that this will be a very gradual process, and consequently, I think we'll see some of the upwards pressure on the US dollar come out, and if anything, it could drift off a little bit. So it's interesting to see, but my feeling is that we're not going to see a lot more upside in the US dollar at this point in time. Now, maybe as we go through next year, if the US continues to tighten, which they probably will, but they get a bit more aggressive about it, and the rest of the world is still easing, then it might become a different story. But I would suspect that following the Fed tightening in December, that we'll see a bit of weakness in the US dollar.
All right, Shane, we leave it on that note. Thanks very much for joining in and talking to us. So maybe the dollar index could come off the highs that we've seen, according to Shane Oliver, post December 15. That's when the Fed is likely to raise interest rates for the first time in almost a decade. But